Hello guys, this video is for those who actually follow me for my new course that I've started on banking, currency, finance, and economics. Today is the second video of the topic. We talked about different types of money. We talked about sound money and fiat money, and we spoke about different characteristics of sound money. Today I'm going to talk about what the gold standard is or was, and how does the banking system work, and how the fiat currency is created. It's going to be a little bit complicated. Maybe I'll just divide that into two separate videos, but I'm going to start off and see how long the first topic goes. So let's talk about the gold standard. What is a gold standard? I'm sure you guys have all heard of gold standard somewhere during your financial news when you're listening to people who work at banks, or economists if you're a trader or investor. So what does gold peg or gold standard means? When the nations or countries or governments decide that they're not going to use sound money as their medium of exchange, because let's say sound money is gold, wheat, barley, rice, salt. They're bulky, they're heavy, they're hard to carry around in the market, particularly in the international market. It's very difficult to transfer those kind of the sound money. So they came up with the idea that, okay, let's start fiat money, which is going to be, they create a unit of a currency which is going to be equivalent to certain amount or certain unit of the sound money. What does that mean? That means, in simple English, if let's take the example of the US government. When the government decided we're going to produce paper money, it's going to be called dollar. It will have certain pictures in the front, certain pictures at the back, and we're going to use this as our medium of exchange. So then the government says, okay, let's take the unit or the dollar and see how much we want to value that equivalent to gold. So let's for example, I don't know what the price was at the time, but let's say, for example, they said, okay, $100 will be equivalent to 1 gram of gold. Means if you have $100, it will buy you the same thing that 1 gram of gold will buy you, and then what this did was, they said, okay, for every $100 that we create is going to be backed by 1 gram of gold, which means down the road, if we decide to do away with the fiat currency, we are going to pay in gold to those who held that dollar. For example, if I had $1 million in my possession, government will have, they have the gold, the sound money priced at $100 per gram. So they will have equivalent amount of gold. They will take $1 million and they will divide that into how many grams of gold would need to pay me back if the government decides they're not using the fiat currency anymore, and they will have to put that as their reserve in the Federal Reserve System. So if tomorrow government decides no more fiat currency, we're not using dollar as our medium of exchange, I can go to the bank and say, I want my gold for the $1 million that I have at the bank account. That's what the gold standard was. That's what the gold peg ratio was, or that's how the dollar was backed by gold. Does that make sense? Means the money has a backing. If the government decides to do away with the money and they don't want to use that money anymore, they will pay me in gold in the form of sound money. So why did they think that it was needed to have fiat currency? As I mentioned before, we live in a global economy. The nations and countries don't just trade within their premises, but they have international trades. They import and export at an international market. Even if it was within the country, gold is heavy, bulky, wheat, barley, rice, all those sound monies that have been used in the history, they're very bulky to carry around, and you cannot do a transfer. In this modern time and age, they needed to come up with the currency which could be easy to carry around, which can be transferred electronically. So they came up with the fiat currency so they can trade at the national and international market. They can use that currency to import and export, but they made sure that they have enough gold or sound money to back up that currency. And that money, that's why the dollar was very valuable, because it was backed by gold. It was backed by sound money, because dollar itself has no value. It's just a piece of paper which is just valueless. The reason why it has value, because the government promised us that, don't worry, this is not sound money, but it is backed by sound money. If tomorrow we decide that we're not using the paper money anymore, you will have equivalent amount of gold that will be worth $1 million, and we'll pay you that. So people had confidence in the government, and people had confidence on the promises of the government, and people started using dollar. So that's what the gold peg and gold standard means. Now let's talk about banking industry a little bit and how banking system works. Um, I'm not sure if you have never been into the financial education and in the financing system or in the economic system actively, or have you studied it. It's very difficult to know much about the banking industry. Banking industry has a history. There are so many myths about it. The banking came into existence because Jews used to sit in the market with a bench, and they will lend people money, and they will say, okay, you pay us this money back, you take this money as a loan, use it for whatever you need it for, and you pay it back to us plus an increment plus a surplus for using our money, because they were charging interest on the money they were lending. And that's where the term bank came from. They took the word bench, they converted that into bank, and that's how the whole banking industry, the conventional banking industry, was created. And they had decided that, okay, we're going to lend money and we're going to take surplus on that money so we can make extra money on whatever we lend. But I'm not sure if that's true or not. Nevertheless, the way banking industry works, if you've heard the term of fractional reserve, banks work on fractional reserve basis. What does that mean? When you hear the term fractional reserve, it mostly, the first thing that comes to mind is, okay, banks have, let's say, whatever amount they receive from the depositors, they take that money and they keep a fraction of that amount as their reserve in case somebody wants and they ask for that money back, so they have some money to pay back, and the rest they invest. So they pay a little bit of interest on the money that they receive from their depositors, and then they lend their money out to other people who need money, and they charge higher interest. So the difference of interest is their profit. That's what the common understanding of the banking industry is. Am I correct? I know most people think that's the case. Is that the case? Absolutely not. Let me make one disclaimer. I often say that the person who invented this conventional banking system was an evil genius. And that evil genius is going to rot in hellfire for eternity for creating this evil system. And I will explain this to you. It's a very long topic, so I'll make multiple videos probably of that. So the way fractional reserve system works is, government sets the fractional reserve ratio for every banking industry. As the Federal Reserve or the state bank or federal bank actually usually sets the limit of how much money banks can reinvest of their depositors. And usually when banks take a certain amount of deposit, they have the right to lend 2%, 3%, 10%. In certain cases, there's no limit. In certain countries have no limits on it. Up to 1,000% of the deposit amount, they can lend it out. So what does that mean? That means, for example, if I went and I deposited $1,000, $100 into the bank will go ahead and they will lend up to $1,000 against that $100 that I deposited into the bank to multiple people. So bank just invented $900 extra from nothing, out of the thin air. That money didn't even exist. They only had $100 in the bank account, and they, against that $100, they are allowed to lend to 2x, 3x, 4x, in some cases 100x, depending on what country you are from. They can lend up to $900 or $1,000 to other people against that $100. That's what fractional reserve means. So this myth that, okay, the difference between interest paid and interest received is the profit of the bank. No, that profit is nothing. That's just a very drop. That's like a one tiny drop in the bucket. This banking industry is robbing people by loaning them the money that they never had, and by charging high interest on the money that they loan, which they don't have. And then they charge so many extra fees and extra costs that you have to pay on top of that. And that's how the banking industry works, and that's what fractional reserve means. Fractional reserve doesn't mean, okay, if bank had $100, they can lend up to $90 and they keep $10 in the bank in case I come back and I need some money. No, no, no. Bank lends out 10 times more or 100 times more of the money that they take from their depositors. And where did that money come from? We don't know that. Out of thin air. They just create it out of nothing. It's just a mere agreement on a paper, that money doesn't even exist. In fact, I have a very interesting story to share. In 2008, during the economic crash, I was working for a bank, and twice a year we had these corporate trainings where those trainers would come and they train us on how to sell and cross-sell the products and services of the financial institutions, how to provide the best customer service. In Pakistan, they're called munjan sellers. But they're not munjan sellers. Their trainings are really very useful, and they do help you become a better person, better salesman, better marketing individual. So they used to train us twice a year at a corporate level. And we were going through this training, and then they showed us a video. It was actually a true story, because during 2008 economic crash, so many people had lost their jobs, and as a result, because of the banking industry's corruption, people had lost their homes, because the houses were being foreclosed upon, because people couldn't make their payments, and then all this interest that they charge on top of the money, that's just extraordinarily expensive, and people don't have the money to pay. And then as a result, the houses were going foreclosure, they were being locked, nobody was living there, nobody knew who that house belongs to, because it was a whole entire mess. And there's a whole large video that I can record on 2008 economic crash. But anyways, the story was that one person who was going to lose his house, his house was being foreclosed upon because he was behind on his payments. And that man, of course, he loved his house, he didn't want to lose his house, so he did some research. He probably knew some basics of how banking industry works and how it works on fractional reserve basis. So he pulled up some articles, he pulled up some studies, and he gathered all the evidence, and he went and he filed a claim against bank who was trying to take over his house and put that house on foreclosure. He said, well, the bank cannot put my house on foreclosure because bank never lent me that money. So of course, banks being bank, they brought in their paperwork, the signed agreement, and they said, he signed the agreement, here's the documents, we lent him $400,000 in loan, and he's behind on his payments, so we have to take over his house so we can put this on foreclosure. And of course, the case went on, and the guy, he was smart, he had done his homework and he had done his research, so he proved the evidence in which he said that by looking at these studies, by looking at these facts about banking industry, banks don't even have the money to lend me to buy this house, the money that they're claiming that they paid for my house. Because if you look at the entire world's currency or money that we use, there's only 3 to 8% money exists in real life. The rest is just a hoax. It's just a mere transfer of few digits from one books to the other, and that money doesn't even exist. So he had obviously done his research on what was the size of the financial institution, how many loans and mortgages and commercial loans and student loans and auto loans they had in their books, and what their balance sheet looked like. So he said, look at this. The size of the bank is XYZ, is claiming that it has lent out this amount of loan. The loan amount exceeds the actual amount that they have in their balance sheet. How did they pay for my mortgage? They didn't even have the money to pay for 90% of the mortgages and loans that they're claiming that they paid for. Therefore, I don't owe bank any money, and hence bank cannot take my house and put that on foreclosure. And his evidence was so good and so strong, mashallah, I'm happy for him, that judge had to rule in favor of that person, and the guy gets to keep his house. So later on then, so after 2008, the entire lending agreement and package was revised. So many new clauses were entered into the mortgage, and all this big book that you sign when you buy a house. If you bought a house in the recent years after 2008, you realize that it's like 100, 200 pages that you have to sign when you purchase a house at the closing table. And that's because they had to add so many more clauses just to cover themselves. If a situation like this happens again, bank can collect the money which they never paid for, basically. So it was very interesting for us to learn that. And that's how banking industry works. It's very corrupt, it's rotten to its core. And I am going to make another video. Of course, this continues because this banking system has a very long history, and there is so much going on within the banking industry, which I can talk about for days, and the topic will never end. But that was just some of the basic information that I wanted to share with you about two things. What is a gold peg or gold standard? How the fiat currency is backed by gold, or should be backed by gold or sound money, and how the banking industry works and how they make profits. So they make profit by they use fractional reserve system, which means for every dollar that they receive, they can lend up to a certain percentage, which could be double, triple, 10 times of the deposit amount. In some countries, actually, there is no limit. Bank decides for themselves how much are they going to lend out against their deposits. They could go up to as high as 100 times the deposit amount. Is really their choice, or 1,000 times as their choice, or 10,000 times of their deposits. It's like nobody has any restrictions on them. And so bank is creating all this money out of thin air, the money that they don't have. they're 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 lending that money, and then they're charging a very high interest on that money. And that's how the banking industries and these financial institutions are so rich and they're so wealthy. And that's what causes the inequality in the society, where the rich keeps getting richer and poor stay poor, because we spend most of our life serving debt. I'm going to end this video right here. This is just the very basic of the banking industry. We'll talk about banking in more details in next videos. I hope this video helps. Please give my video a thumbs up. Subscribe to my channel. Please watch these videos very careful. They are going to give you some life learning lessons of finance, and it'll make you a very savvy investor, a savvy individual who knows their finances and who know how to manage their finances. It will come handy. We obviously cannot change the world economy and the nation's economy, but we can change our economy inside our household. We can train our kids, we can train our spouses, and we can control our wealth, our finances, and generate wealth if we understand it better. So please take care out there. Please spend your money wisely. Please invest wisely. I will continue recording this video. I'll try to do one video every week. I'll try to maybe start 2 videos a week if I can. But so far I can only promise one. Please subscribe to my channel. Please share my video with other family and friends and family members. Maybe they can get benefit from it. Until next video, take care.